In this video, we're going to talk a little bit about one of the most recent financial catastrophes that has hit our economy. And this has to do with home mortgages and the mortgage crisis of the early 2000s. So let's talk about how mortgages worked prior to securities and loans being involved. So the problem is if an individual investor tried to lend money to an aspiring homeowner, right? So the individual investor might not have enough money to fund the entire home. So they might not be in a good position even to evaluate the risk of the potential homeowner. So individual investors might have difficulty collecting mortgage payments, right? So prior to the investing world, looking at how people can buy homes, there was a gap, right? So what happened is then we created this industry that lends money, especially those to homeowners. So the savings and loans help solve most of these problems. The S&Ls pooled deposits together. That money was then used to provide funding to buy houses. They were able to develop an expertise to evaluate borrowers. And then, of course, they had the legal resources to collect payments should payments not be paid on time. So the concept here, though, is money, right? How does one savings and loan get enough money to buy entire homes all at one time? The problem is that it's referred to as this pooling, right? Now, what was invented, if you will, is something called securitization. So what happened was there are companies that would go to S&Ls and banks and say, we will buy your mortgages. So if the S&L had $30 million worth of mortgages, they might not have any more cash to lend out, so now they're stuck. This company would come in and they would purchase their mortgages. So they would give them $30 million and they would now get the loan document. So now the people that are making payments not to the S&L, they're really making payments to this outside entity. So the outside entity question is, where do they get their money? They create bonds. So we have these companies referred to as Fannie Mae, Freddie Mac. These are all companies, Ginnie Mae is one, that primarily create this mortgage securitization industry. So again, how does that work? Again, they issue bonds to gather money. That money is used to buy the mortgages from banks. The owners of the homes make payments. Those payments go to the entity, Fannie Mae, for instance. Then Fannie Mae takes that money and distributes it to the investors in the Fannie Mae because they own bonds issued by the Fannie Mae. So again, this is what's referred to as securitization. So in the 1980s, we had problems with interest rates for a variety of reasons. Primarily, the government repealed something called the Glass-Steagall Act, which basically, it's DDMICA of 1980. DDMICA of 1980 essentially released interest rates. Prior to that, interest rates had a ceiling. You couldn't charge over a certain rate. After DDMICA was repealed, now interest rates could float, and interest rates got extremely high. In the 80s, we had double-digit inflation. So what happened? The S&L industry couldn't keep up with this, so many of them failed. So what happened? When the Fannie Mae was created, it took over some of this stress from the S&Ls. So the risk shifted from the banking industry to Fannie Mae. So now Fannie Mae is taking the risk of this mortgage industry. So how does Fannie Mae shift risk to its investors? Well, it didn't disappear, it's just been shifted. Fannie Mae doesn't keep the mortgages. They put mortgages in pools and they sell shares of these pools to investors. So the risk is in essence now shifted to investors. But investors get a rate of return close to the mortgage rate, which is higher than that the S&Ls pay their depositors. So again, and the investors have more risk, but they also have more return. And again, this is just that process that's referred to as securitization. So in the early 2000s, something was created called a collateralized debt obligation. So Fannie Mae and some others decide they're going to split these mortgage pools into some special categories, if you will. So some securities are going to pay investors only the mortgage interest. They're going to be like an interest payment. Others might only pay mortgage principal. Some securities might mature quickly, others might be later. Some securities are senior, they get paid for other securities, and some are junior. Rated agencies give different ratings, if you will, for the different types of securities within the batch. So the risk of the basic mortgage has now been separated, if you will, out to those different investors. So we have one entity, a mortgage, that now has been disassembled, if you will, to different kinds of investors, different kinds of risks, different kinds of returns, etc. The challenge with this is what happens when these different things are sold and something bad happens to one. Right? So my example is you can't unmake gravy. Once gravy is made, you can't take it back apart again. So that has been the problem with these collateralized debt obligations, is that we've created a situation that cannot be returned back to its original position so that we can assist, if you will, when times are bad. There are all kinds of assets that can be securitized. Car loans, student loans, credit cards, all of these things have been securitized over time. So again, what is the big problem with this securitization? So this is essentially what happened in the early 2000s. Homeowners wanted better homes than they could afford, right? Everybody wants to own a home. Not everybody has the financial capabilities to pay for a home. So brokers were encouraging homeowners to take mortgages even though they might not be able to pay for it, because the brokers got a commission just for closing the deal. They didn't get paid if it was a good loan. The loan was good if it closed. Appraisers thought the real estate boom would continue and thus overappraised some house values. So now we have people that can't afford loans being encouraged to take loans on homes that may be overvalued. So there were a lot of originating institutions, Countrywide was one of them, that quickly sold the mortgages, and other institutions. So they didn't hold them long, so they passed the risk on to someone else. So these investment banks created these CDOs. They got rating agencies to help design them and then rate the new CDOs. The challenge is this design, the risk element was not properly vetted, right? So financial engineers created some of these values through their risk and valuation process, and they used some possibly unrealistic inputs. Investment banks sold the CDOs. Investors bought them, but either didn't understand them, didn't care about the risk. Now, some investors actually bought insurance via something called a credit default switch. So this risk piece has been desegmented, spread out through the entire economy. And when bad things started to happen, when these people that got loans that shouldn't have had loans, when they lost their jobs, when they quit making payments, that risk filtered through. But who does the risk go to? Because you can't find it, because it's in this, as I refer to it, it's in the gravy. So when mortgages reset, borrowers defaulted, the whole thing collapsed. So many of the originators and the securitizers still owned some of these subprime securities, right? Lots of bankruptcies, lots of takeovers, and most of these companies had something bad happen to the company themselves, not to mention the people that bought the homes. So there was a tremendous upheaval of the mortgage industry, financial services, and certainly the homeowners that were affected by these bad loans being made. So I look forward to talking to you in another video. Bye-bye.